Yes, thank you, everyone. Thank you, and welcome to today's Sovryn Tea. Thanks for joining us. My name is Magnus, and today at Sovryn, we're joined by Edan Yago, plus Matthew Pines and Troy Cross from the Bitcoin Policy Institute. Ladies and gentlemen, don't forget that Twitter Spaces are interactive. We'll be taking questions at the end. I'm already seeing some speaker requests. Just hold on to the end, and we'll get right to you. So to discuss today, we are joined by Edan Yago. He is our in-house guest. He's a Bitcoin OG. He's an early contributor to the Sovryn protocol. He's been in the space since 2011 and has founded multiple Bitcoin-focused companies. He believes that Sovryn plays a crucial part in creating a world built on Bitcoin. Also, we have
Hello.
And also we have Troy Cross. He's a professor of philosophy and humanities at Reed College and is a fellow at the Bitcoin Policy Institute. He's been involved in Bitcoin for over a decade and focuses on the question of bringing Bitcoin mining to the Bitcoin mining's present and future environmental impact, something I'm really excited in getting into. And finally, we have Matthew Pines, who's a consultant with the U.S. government on security and resilience challenges. He's a National Security International Policy Fellow at the Bitcoin Policy Institute and evaluates and advises how Bitcoin intersects with national security issues. But folks, to get this started, let's start with some Bitcoin jokes as a little icebreaker and to lighten the mood. I'll get it going. A boy asks his Bitcoin investing father for $10. Father says, $9.82? What do you need $10.08 for? Don't laugh all at once, folks. I got one more for you. Why don't vegans use crypto? They can't provide proof of stake. Thank you. All right, let's get rolling, folks. Thanks for laughing through my cringy jokes. So the first question is for our guests. Could you please give a lowdown of the Bitcoin Policy Institute for our listeners? We hear you get up to no-nonsense Bitcoin research. Could you tell us a little about it?
Hey, Troy, want me to take that one to start?
Yeah, go ahead, Matthew.
Hey, can you hear me okay? Just want to confirm audio's good.
Sound both great. Yep.
Awesome. Yes. So Bitcoin Policy Institute is just a think tank, just kind of got off the ground just a few months ago to really try to put out some well-informed, kind of fact-based, both kind of long-form research articles, kind of on some of the hot topics of the day that we know are going to inform kind of the broader policy conversation around Bitcoin and sort of Bitcoin specifically in the United States. So things like, the economy, the energy, kind of climate debate, national security, kind of those kind of key topic areas are going to be some of the focus areas. We have a number of fellows. You can go to our website, btcpolicy.org, look at some of the folks that are kind of be contributing to some of those things. We've also been trying to engage just in the kind of the past 2 months or so on some of the kind of more kind of emerging things that happen when there's a congressional hearing or there seems to be, a kind of particular piece of FUD out there that needs to be responded to. So we put out some fact sheets, kind of one-pagers to try to put out some relatively kind of high value add kind of slick sheets that can be sort of circulated to help rebut some of those kind of stories that get that sort of get around the Twitter water cooler. But yeah, I mean, just kind of new kind of think tank. I think we're going to be doing a lot more this year. But yeah, just kind of engage in the policy conversation. We're not really lobbyists, so we're not going in kind of actively shaping legislation or and that sort of stuff, but really trying to focus on just getting kind of white papers and more kind of rigorous kind of analytical reports out there to kind of inform the broader policy conversation. So yeah, that's kind of our I think for Troy and I, this is not our day job, but trying to put some of the stuff out.
Great. Yeah, it's great to even take an active role, even on a part-time basis, in getting that the Bitcoin voice out there. I was going to go through both of you, everyone at once, just individual questions, just going over your background and what you're working over right now. I was going to start with Troy. Troy, here's a quote from you. Bitcoin is a perfect match for renewable energy. It helps monetize the build-out of renewable energy, helps monetize the operation of renewable energy. It helps to stabilize the grid, and we need it to happen at a massive scale. So that's all a big statement. Do you think you could give us a lowdown on how Bitcoin does this in a nutshell, if that's possible?
Sure, yeah, and thanks for having me today. This is a nice opportunity. I think that to this point, energy use and emissions has been, I think, the number one obstacle to major investment in Bitcoin. it's the thing I encounter most, at least when I talk to people. But we also know that it's an issue that's raised in Congress and the Senate, in major newspapers. It's partly the impetus behind a lot of altcoins. And I think we've been playing defense on this issue, rightfully so. In recent history, we've been saying like, it doesn't actually use that much energy. The energy usage for Bitcoin is, I don't know, something like, it's like 0.6% of electricity right now, and maybe 0.3% of primary energy. That's a pretty small number. And with the halving, the projected energy use is supposed to top out at, not much more than where it's at. Maybe we hit 1%, right? So a lot of the rhetoric from Bitcoiners has been just pointing out the exaggeration of the energy FUD, and then pointing out also that Bitcoin's energy use is greener than other industries or the grid, and pointing out that a lot of Bitcoin's energy is wasted energy or stranded energy, and that it's a non-rival consumer of power. So it's not driving up overall energy production so much as making better use of the energy that we're already producing. All of that's good, and there's many more sort of lines of anti-FUD that I've worked on, Matthew's worked on, and our colleague at the BPI, Margot Paez, has worked on. But it also kind of strikes us that being on the back foot and being defensive is kind of the wrong way to think about Bitcoin and energy, and that, in fact, we have a much more positive story to tell. And that story is that, just as I said in the quote, that Bitcoin helps to incentivize the transition to renewables. It's exactly kind of what the renewable industry needs. We recently had the Green New Deal stalled due to one senator from West Virginia, and we do not have the kind of massive public support for a huge infrastructure investment in the smart grid and in the renewable build out. But Bitcoin kind of does what the government failed to do with respect to green energy, in the sense that it allows a green energy producer to sell off-peak power and monetize it, and thereby reduce the price of power that they charge to other people potentially, but also just pencil out as a viable business. It also allows renewable power producers to monetize their energy in advance of grid connection. So you could build a solar plant, and while you're waiting, like the wait times for connection to the grid vary widely, but it can be many years actually, and it's kind of an unknown. But if you have Bitcoin miners as a consumer, an off-taker of power, and you know that in advance, you can build out a plant without having firm knowledge of exactly when you'll get connected. You can build out in advance of connection, and that solves a kind of chicken egg problem. But also, you sell ancillary services back to the grid. You're kind of an insurance product, because Bitcoin miners can turn off on command, or they can reduce their consumption of electricity by degrees. They're perfect for balancing the load, so that when demand spikes on the grid, you can turn down those miners and you'll have ample supply of power. So people like to say that renewables are good for the environment, but they're terrible for the grid. And to actually function, you need high amounts of flexible load, things that can buy energy when it's there and not buy it when it's not there. And Bitcoin is the very best flexible load. The IEA, International Energy Association, estimates we need a tenfold increase in flexible load by 2050 in order to hit our climate targets and our targets for adoption of renewables. That's going to require huge amounts of flexible load, and Bitcoin is the best provider of that. So it's very unintuitive that you can have something that adds demand for electricity, and yet at the same time, by adding demand, you actually lower prices and you increase profitability. But that's kind of what Bitcoin is. Okay, that's a lot. I spit out a lot right there. But the positive narrative is basically if you think that we need to make a transition to renewables, of course, a lot of Bitcoiners do not think that. But if you do, Bitcoin is going to be an essential tool in the toolkit to get us there, to do it without the kind of subsidies that we might have gotten through something like the Green New Deal. Because Bitcoin is a subsidy, essentially. When you're selling off peak power and turning it into sats, that's an instant monetization of excess power. And that is exactly the kind of product or consumer that the renewable industry needs.
Troy, I'd like to ask follow up on that. So the CapEx, right? So the capital investment made by setting up Bitcoin mining facility or operation, we're looking at, I think today, about 3 years, something between 2.5 and 3 years to break even. And that's before factoring in or only partially factoring in the electricity costs. Now, if you are providing intermittent mining, right, only when the sun is shining or only when there's peak load, that stretches out significantly. And I'm not sure I understand how miners who are operating in that way can be cost competitive with miners who are able to work with load that is available to them 24/7.
Okay, this is interesting because, yeah, I had the same thought, of course, but that's because you're thinking about new miners and you're thinking about one kind of demand flexibility. In fact, these mining operations divide into two kinds. One only uses old machines that are basically borderline profitable, S9s, and they only run them when there's excess power. And if you look at the cost curve and ERCOT, and you look at the cutoff point where S9s are profitable, they're profitable maybe during 2/3 of the time to run, and they're extremely profitable, of course, when power is actually priced free or negative, as it is sometimes on the ERCOT grid. So that's your kind of one bank of miners. They just kind of sit out there and run only when it's profitable. And the reason they're profitable to do that with is that they only cost a minimal amount of money because they're already 4 years old. It's basically like miners, if they're kept clean, have a pretty long lifespan. So this is the sort of tail end of the lifespan of a miner. Like once you're done with your kind of active duty and you're not really efficient enough to make power, to make money at standard electrical pricing, you only operate at this ridiculously low or even negative pricing. And then
so it's like a retirement home for old miners.
Yes. And then new miners need a lot of uptime to be profitable, but they can still be demand responsive because they get paid for these periods of off time by the utility. And it still makes sense for the utility, actually, because they're such a good consumer for the rest of the time, and the probability that they'll need to turn them down is low enough that it pencils out for both sides. So, for instance, in the Texas winter storm, when miners were shutting down, those were brand new miners, like shutting down. But but they were getting paid to do that. Some of them had agreements to get paid. Others were shutting down because the price went to 50 cents a kilowatt hour, right? So if the pricing is dynamic, as it is for a lot of miners, then you have to shut off when the price spikes. And then the question of like payback time, like how long does it? Well, it depends. You got to negotiate each of these contracts independently. It depends on like what your banks of machine are and what the contract stipulates. But there's actually a continuum between brand new miners and retirement home miners, and so there's like a continuum of kind of power deals that will make sense, which is great because there's a whole range of kind of insurance products that the utilities need to buy from miners. So yeah, once you're absolutely right. It would not make sense to just buy a bunch, let's say, all new miners, and set up like next to a wind farm that hasn't yet been hooked up to the grid. That would be a losing proposition. Or the solar farms that are being put in now all have at least a 4-hour minimum battery right now. But even with the 4-hour battery, you guys have too much downtime, and by the time that you get the hashes you want out of your machine, we'll be through another halving, and Lord knows what other chips are going to come out and how much more efficient they're going to be, or with advances in immersion cooling technologies, overclocking. It's a huge bet to bet on brand new machines for that kind of setup, but they're perfect for older machines, which are still a large percentage of overall hash rate.
And to what extent is this currently theory? As we can model it out and it makes economic sense. And to what degree is it actually being put into practice?
Well, that's something that Marco and I are actually trying to study right now. I mean, we're in touch with a lot of people in industry, but we would also like to answer exactly that question in a peer-reviewed scientific journal, because most of what we can actually find is models, and then we can also find miners claiming to be doing it, or people who are selling software on how to split your power between grid, battery, and hash rate, and claiming that they have customers, but we haven't actually proven it. We don't have proof, to your point, and we think we can get it, and we're in the process of kind of trying to raise money for that study, because it'll be kind of a big undertaking, right, to try to get data. A lot of the data is proprietary. People don't want to tell you exactly what they're doing. But there are ways we can get some of the data from ERCOT, from industry groups. And all I can say is Margo and I are working on it. and the models look good, and we have knowledge of people who claim to be doing it.
Well, thanks for that, Troy. It's we always get this question all the time, everyone who's involved in Bitcoin, about the environment, et cetera. It's good to have some arrows in the quiver to deliver some nuance to this discussion. So appreciate that, and doing your best to put that in a nutshell. So we'll move on to Matthew for now. And Matthew, I was going to paraphrase a quote from you. You said, "A legit central bank with a material amount of capital moving into Bitcoin was once a theoretical proposition, but now you can see it in the next year or two, which is a game changer." So I was going to ask you, Matthew, why would a central bank take this route, and how would it benefit them?
Well, I think it's important to step back, right, and why kind of I think I put that out there. I think I was again, right, to try to, it's somewhat of a controversial claim, but I don't think it's actually that implausible. And I think what we've seen, I think in the past month or so, is both tail risks moving to the center of the probability distribution. And I think that has also brought maybe sort of tail events in Bitcoin closer to the center of the probability distribution. So I don't speak in terms of absolutes or kind of make predictions. I just look at kind of, what I would sort of think of as a distribution of scenarios, and look at how sort of recent events have shifted the distribution of what I would have considered kind of sort of probability to place across those. And so I think really the Russia war, the Western response to that in terms of an economic war, has really, I think, structurally changed how the global monetary system is going to evolve. And so I think one consequence of that is going to be, raising the probability that you could see a central bank, make a material position, get a material position in Bitcoin. That sounds kind of crazy, but, there's already sovereign wealth funds like Singapore and some other, smaller funds that have, invested in the space, maybe not actually owning Bitcoin itself, although, I don't think we really know the answer to that. So it'd be sort of those two sorts of countries who are looking for kind of what's kind of called outside money, or sort of counterparty-free money that might be more like a flyer on maybe a retreat to kind of like a gold position. But the reason they would do that, and I think it's really something that's brought up in the context of this emerging great power competition between kind of an emerging Eurasian axis of authoritarian systems that has been sort of converging in terms of an alignment of interests across the Eurasian continent, principally dominated by the two major political powers, Russia and China, and the Western sort of dollar-based kind of quote-unquote rules-based international order. I think that is the sort of core strategic competition, if not outright conflict, underway right now. And money is going to be in the so really money is going to be at the center of that competition, right? The power to control what is money, what counts as money, who answers the question what is money, is going to be the key question of the decade, right? Both money in terms of mediums of exchange, so what prices commodity goods, who holds the power to sort of denominate the pricing, but also where does sort of the revenues, the store of value of global wealth go? In the globalized world that we all lived in the past several decades, the answer to that question for most countries around the world were U.S. treasuries, which served as, quote unquote, the most safe and liquid store of value asset, as well as the most kind of pristine collateral to use in any dollar-based funding transaction around the world. And while there were, not necessarily sort of friendliness between the U.S. system and kind of Russia and China, sort of the sort of rogue nations were relatively minor kind of contributors to the global economy and could sort of be safely kind of parked in the corner, whether you're North Korea or Iran or those sorts of countries. Well, the move against Russia in response to their invasion of Ukraine kind of really represents like a fundamental cleavage in that globalized world order. And that's going to precipitate, I think, a cleavage in the global economic monetary system associated with that. And I think, Bitcoin's going to now emerge in the context of that larger global dynamic that's playing out. And I think that's going to be an impetus for certain players to look at their exposure to the dollar system, exposure to the global economic order, and just look for hedges like you would if you're a hedge fund manager, right? You look at your exposures, you look at kind of your tail risks, you look at where you would apportion your global savings. I think the chances of a foreign reserve manager making that decision on the margin has increased as a result of the past sort of month of geopolitical and sort of economic events. So that's kind of the context for that. I think the key point that I'm looking at is really what's going to be the trigger, because I think a lot has to happen before you would see Bitcoin be used as like a medium of exchange for denominating, say, like Russian oil sales, even though that was in the news today. I think that was a kind of a provocative statement by the Russian minister. Again, right? It would be, I think, an interesting development, and it's again not impossible. And I think that the key thing for me has been taking things from the realm of kind of entirely theoretical possibilities, right? Like, yeah, maybe one day, to plausible. Now, saying something's plausible doesn't mean it's likely, though. And I think there's a lot we're a few steps away from putting a nail in the coffin of the dollar system. The final thing I'll say, just by way of semantic distinction, is some folks confuse sort of the dollar reserve currency status of the dollar versus the U.S. Treasury reserve status as the sort of reserve asset. Because there's kind of played two different roles. I mean, the unit of account for global trade is the dollar. It's, what that symbol is on the screen that says this is how much money you have in your account if you're trading dollars. It's a unit of account. It's the medium of exchange for global trade. So it has powerful network effects in that regard. But most folks at scale don't hold dollars per se. They hold treasury securities, which they feel like they can liquidate on demand for dollars in order to, make transactions. Sometimes they'll actually even just trade in treasuries and actually use the treasury securities as themselves as a form of payment or medium of exchange. But for the most part, the treasury security is the global reserve asset. And I think that's actually much more structurally important to the global economic system than the dollar as the global reserve currency. It's sort of what you choose as sort of the common language of the money you're exchanging. But where you're going to hold your savings, where you're actually going to hold your assets is sort of more important. And so the question is not really, Bitcoin competing with the dollar per se, at least not in the near term. It's Bitcoin competing or potentially supplementing the U.S. Treasury security as a new counterparty-free asset that is not just in the purview of global central banks and institutions like Treasury securities are, but as a reserve asset that can be held by anyone with a smartphone and the wherewithal to buy Bitcoin. So I think that's kind of the structural trend relevant to Bitcoin that's emerging from this unfolding geopolitical and sort of macroeconomic dynamic that was precipitated by the sort of Western economic response to Russia's invasion of Ukraine. So there's a lot there.
Yeah, a couple of questions in relation to that. One is, why do you think that governments seem to be more threatened by Bitcoin as a commodity type money than gold? Is it just status quo bias? And then the second question is, if you were to venture a guess or a thought as to which central banks would be the most likely to be the first to venture into this type of new reserve asset, how would you think about that?
Well, I think to answer the first question, we were on a commodity-backed gold, essentially a gold-backed dollar standard, post Bretton Woods up until the Nixon shock, and that had its advantages for the U.S. power, it's kind of the U.S. centered power system during that period of time until we couldn't make the redemptions, and so the U.S. has run that system before, and they know it has an expiration date on it, and they know it has other consequences that they would have to sort of absorb. And when Nixon sent the Secretary of Treasury to Saudi Arabia and met in Jeddah with the king, the deal they worked out when they called it the petrodollar system, it really wasn't the petrodollar system; it was the petro treasury system. Back to my original point, and the key point of that agreement, which was played out over the course of the 20th century in other countries, was essentially recycling revenues in Saudi Arabia and the OPEC countries from oil sales into U.S. Treasury securities. So we basically were able to print money, essentially, finance our debt, acquire hard assets, and specifically energy, and then recycle those revenues that those countries accrued from those sales back into our economy and to finance our debt. And that sort of expanded and accelerated throughout the 20th century. We sort of found new nations to sort of suck into that treasury dollar recycling system. Japan with the Plaza Accords. We even got Germany to do it. And then China was the big kahuna when we brought them into the World Trade Organization, gave them most favored nation status in 2001, and then really put the sort of the turbojets behind that system, which really benefited certain elements in the United States, right? If you were connected to sort of the financial system, if you were part of that sort of treasury recycling mechanism, you stand to gain a lot. And so, but at the cost of essentially offshoring our manufacturing base, growing China's wealth, allowing them to industrialize, build up their own military power. What really changed was in 2013, China realized, hey, you know what? We think we have enough treasuries, and we're going to sort of marginally, sort of not buy any more of those. We're going to instead take the dollars we accumulate from your structural trade deficit with us. You have to buy all the goods from the factories that you helped build for us. And instead of us taking those dollars and buying your debt, we're going to re-lend those dollars out across Eurasia, even South America, Middle East, Africa, to secure hard assets. That's been the Belt and Road Initiative. And so they've been embarking on a pretty strategic plan to take those dollars from our trade deficit and essentially re-lend them to spread their sphere of influence. And that system, so that the exorbitant privilege of the dollar has now essentially turned into an exorbitant burden that's been sort of weaponized by our principal adversary. And I think that's sort of the crux of the moment we're in now, is sort of the pathologies of running that system for so long has now made kind of the strategic challenge facing the United States sort of especially acute. So they're at kind of a crossroads moment that this particular crisis is now precipitating. And essentially it's a choice between, do we keep this sort of 50-year system, which is now sort of started to sort of eat our own seed corn, going, or do we have to find something else? We have to sort of float sort of global trade in a neutral reserve asset, because we can't keep this sort of treasury recycling system going indefinitely without having to monetize our own debt issuance and lead to runaway inflation. And so, there's a lot of incumbent power, there's a lot of incumbent money. Their entire lives have been built around this system for the past 50 years. So their bosses and their bosses' bosses all sort of worked up the ranks in government, in the Treasury Department, in Wall Street, seeing this system sort of reach its sort of apotheosis of power. And when you're on the top of the mountain, right, you don't want to change things up. You like it, right? And so structurally, sort of the incumbent boomers who run the system don't want that system to change. And it's a matter of, okay, well, are they forced to change? How much pain does everyone else have to experience before they realize that this can't keep going? Your second question of who might be the first movers here in terms of central banks. Well, I think it'll be smaller, more kind of innovative nations that have already sort of dipped their toes in the water, like Singapore. I mean, there's maybe some of the Nordic countries. Again, I'm not sure it's going to move the needle globally, especially as Bitcoin is already a pretty liquid market. What I'm really paying attention to is, I think so. This isn't all going to happen like in an instant, right? These sorts of things are phase transitions, and they're messy, and they're dynamic, and they don't just sort of go from one stable order to a new stable order. When your stable order becomes unstable, things are just messy and chaotic, and countries are kind of scrambling for positioning. They're hedging their risks. They don't quite know where the new equilibrium is going to be, and so that's where you'll see kind of random experimentation in that sort of chaotic kind of phase transition unfold, and folks may just decide, hey, we're going to hedge over here, and kind of because we have no other options. And in that context, I think as people look for alternatives, as a sort of marginal shift goes from inside money, treasury risks that now suddenly have counterparty risk, to on the margin movement towards outside money, namely commodities, gold, and Bitcoin as sort of the new player in that realm. What I think they're realizing is that gold does have structural disadvantages. I mean, all of the countries that would otherwise go to gold, if the inherent problem with the treasury system that you're seeking to avoid is counterparty risk, well, most countries either have their gold in their own vaults, but they could be sanctioned in terms of transactions, like U.S. Treasury is trying to do on Russian gold, right? If you want to liquidate that gold, you got to find a counterparty and exchange, and if you're a sanctioned entity, right, the U.S. government could sort of try to penalize that intermediary institution that's facilitating that trade, or you've actually let the U.S. Fed custody your gold, so you have it under Liberty Street in Manhattan, and when you make a gold transaction, the U.S. Fed custodian just essentially moves the bars on a cart from one cage to another cage, and just changes essentially the labels on that gold. So fundamentally, that gold, what you call outside money, isn't fundamentally any different than the treasury securities. It's just a different counterparty risk, or it's the same counterparty risk, just like in a different form. So I don't even know if that doesn't really eliminate the risk for those countries, unless they were to take self-custody, and then you're really rewinding the clock back to the 50s and 60s, where people are physically flying gold or doing battleship escorts to sort of settle global trade. And that could be a system, but if that system we go to, I think globalization as we know it will have completely broken down. Global trade is a mess, and we're just fundamentally living poor lives across the board. So that just is not a very efficient system for a 21st century economy. And so that does lead you along the chain of logic that you could see nations eventually going to see Bitcoin as a form of a neutral asset that does allow them to sort of eliminate that counterparty risk, but also be able to sort of settle global trade in a neutral way, but without kind of the structural inefficiencies that gold presents. So that's sort of, I could see the logic there, but again, there's a lot of power involved, right? And not every country, feels like they have the autonomy to do that, right? That's essentially the lesson, I think, of the 20th and the 21st centuries, is that, some of these countries, they've sort of willingly sacrificed some of their sovereignty in order to get the security umbrella of the United States. You essentially say, we'll accept that counterparty risk, the fact that, our access to the dollar system can be sanctioned or restricted, in order to become, under the protection of the United States, get the military protection. And so when it comes down to it, it's hard power. It's the credibility of the U.S.'s military commitment to their defense. And so really that type of move at scale would really be precipitated not solely by any loss of confidence in the treasury system, although that would be a precondition. It would be really a loss of confidence in the U.S.'s willingness to really sustain its military commitments to all the members of the dollar system, since that's essentially the deal that you make by being a participant in it.
So Matthew, you have mentioned trying to orange pill the U.S. government, which may or may not come in at apt time for them. How can Bitcoin specifically help maintain U.S. hegemony, as you've said? And would you actually say that's in the spirit of Bitcoin, actually?
Yes, when I speak of the U.S., I speak of the country, right, and the people living in it, as opposed to the U.S. government, which is, at least in the system that I think we have, is, at least nominally, quote unquote, representative. And so when I say it's good for America, I mean it's good for Americans, and I think that's true, right, in the sense that, well, one, a lot of Bitcoin, if not, the majority of Bitcoin, is sort of held by U.S. individuals, U.S. custodians, and so if it were to monetize, to say replace or supplement gold as sort of a global reserve asset, in kind of a first phase, U.S. citizens, U.S. sort of aggregate wealth would disproportionately benefit. And to the extent that U.S. national economic strength is going to be strengthened by that, then that's good for the United States as an economy, as a country. Not to mention, the intellectual capital of sort of bringing people who can contribute to the Bitcoin economy that could flourish in the United States, companies that list on our stock markets that help develop our capital markets, individuals that start mining companies, to Troy's point, kind of help accelerate this sort of dramatic transformation of our domestic energy system and meet our kind of our electrification flexible load objectives. So if you're looking at it from just kind of the economic lens, Bitcoin's growth is good for U.S. Sort of economic position and sort of the wealth of our people, especially if this system is going to start to, the global dollar system might be fraying at the same time. At least you have a backstop here that can sort of help mitigate, if not counterbalance, the instability that could precipitate. But I think overseas, kind of on the international stage, the other kind of key point is, one of the main lines of competition that's emerging is sort of as I mentioned, kind of this Eurasian axis of authoritarians is principally led by China, with sort of Russia now effectively being tucked under their wing as they kind of go on this misadventure in Ukraine, making them sort of even more beholden to China. And China, as I mentioned, with that BRI initiative, has pretty ambitious efforts to at least establish themselves as a peer power competitor in the global system to the U.S. And they obviously are no fans of Bitcoin, having kicked out the miners, banned it multiple times, and they're serious this time, and really rolling out their digital currency, both domestically as an instrument of social control and surveillance, but also internationally as a way to sort of ensnare developing countries, emerging markets, sort of into their system. Both their sort of trade system, which they've said that sort of bilateral kind of currency swap agreements, but also kind of more fundamentally, kind of their governance system. So the DCEP, which is their kind of digital yuan kind of technology suite, is really being exported alongside a whole other suite of technologies of control and surveillance, essentially, that a lot of countries around the world, really want, especially countries that are run by authoritarians. Essentially, here's a authoritarianism as a service that comes with, all of Chinese surveillance technology, AI, and the digital yuan to boot. Well, if the United States, quote unquote, wants there to be quote, more democracies in the world, if that's something we actually want to see, then we should seek to try to counter China's ambitions in spreading the digital yuan and the associated kind of technology suite that goes along with it. And to that extent, Bitcoin is an enemy of that, is sort of the opposite of that. And China sees Bitcoin as an antagonist to their efforts to spread the digital yuan. And people around the world, look at Nigeria, where there's been, some efforts by China to try to link up their CBDC with the Nigerian CBDC and try to impose kind of top-down some of those efforts, while bottom up, the organic adoption of Bitcoin and dollar-based stablecoins is showing kind of where true demand for digital currencies and digital assets exists. And so to the extent, this isn't something the United States, I think, necessarily needs to counter with a CBDC, right? You're not going to out authoritarian or out totalitarian the Chinese. What you compete on is freedom money versus totalitarian money. And so letting Bitcoin and sort of the dollar-based stablecoin ecosystem sort of fight the fight that you're not even, maybe even waking up to against the digital yuan is sort of the other aspect of which Bitcoin can help support kind of U.S. global national security interests, sort of countering our strategic adversaries and kind of this competition over the future of money.
Okay, thank you for clearing that up. Actually, it makes a lot more sense now that you've run through it. I was going to move over to Yago. Yago, the space is called the Bitcoin future. We've been talking about macroeconomics, the future of Bitcoin working in conjunction with renewable energy, et cetera. Yago, in terms of personal finance, financial sovereignty, you've talked a lot about forward-thinking future ideas and been working on a lot of projects with Sovryn itself. Could you delve into some of the stuff you've been working on that people in the future can use for now and in the future for their own personal financial sovereignty?
Yeah, so I think the nature of sovereignty itself is changing before our eyes, at least in terms of how we can understand it. So the degree to which economic war is being waged rather than physical war has been a growing trend now for several decades. We've seen sanctions used as the primary tool of effective aggression or politics by other means against Iran, North Korea, Venezuela, and multiple others. We've seen trade wars between China and the U.S., and now the most dramatic example in the in this current conflagration between Russia, Ukraine, and the West. At the same time, we've been seeing, and I think this is even more clear, a increased weaponization of finance as a tool for governments. And the most obvious example that we all talk about is Canada recently, but there have been so many examples that it's been clearly a trend. So the KYC AML has become a blanket tool for all types of political action. There was Operation Choke Point by the Obama administration to try and limit access to banking for all kinds of what they considered undesirable industries, pornography, legal marijuana growing, and multiple others. The way that the U.S. initially attacked poker in the first part of last decade was by limiting the ability to poker companies, online poker companies, to take payments. We've seen it happen across the board. Anyone who's been in the crypto space for a while has seen multiple companies basically being taken off the ability to provide banking to their users. We saw Bitfinex have $800 million confiscated, and the list really goes on. I posted a thread last week on just a bunch of examples. And the reason this is such a powerful tool is because financial sovereignty is really the bedrock of freedom. So ownership is freedom in the most literal sense. But it is not the only type of freedom, obviously. So I think the remarkable thing about Bitcoin is it has provided us with a alternate system which places sovereignty in the hands of the owner. And that owner, it scales all the way from the individual all the way to countries. But I think this is conceptually a bigger deal than just money and payments. I think it matters also for the type of financial activities that we could be engaged in. So if you look at Western countries, they are massively in debt. And one of the biggest forms of debt, which doesn't even appear on the GDP to debt ratios, is unfunded liabilities, the biggest one of which is retirement plans. We exist in a world where we now have across the wealthiest nations hundreds of millions of retirees who have retirement obligations from their countries that are not going to be met. They're not going to be met either stealthily through the process of inflation, or they're just going to be defaulted on. And we'll probably see a mix of both of those. So providing more sophisticated types of financial tools, for example, a retirement plan, which isn't dependent on a counterparty and certainly not dependent on a state-managed counterparty, I think is crucial. We have similar problems with access to housing, which is a massively state-intervened industry. And so financial tools around that. And then we see very obvious things like the ability to trade. So, we had last year, Robinhood effectively eliminated the ability for a large number of its users to sell stock options and stock in their sort of like meme stock offerings. So we also need the ability to have intermediary-free trading and transactions of everything from stocks and equity-type vehicles to debt and commodity-type vehicles. And again, where we are seeing this most obviously is in the Bitcoin trading and crypto trading space, but that is a canary in the coal mine. And then finally, on top of that, there is more sophisticated, not directly financial types of activity. These are complex activities like the ability to create a company and manage a company without conforming to regulatory sanctions. Today, every single company is dependent on the laws of the company in which it is instantiated. And that is becoming a more and more cumbersome vehicle for an increasingly globalized world, a world in which borders increasingly don't matter. And other types of activity. So my sense is that when I think about hyper-Bitcoinization, when I think about building a world on Bitcoin, what I mean by that, for me, it's building a world based on the principles of Bitcoin, which is that we distribute power to the owners, to the individuals who ultimately are creating value and owning value, and that ownership and the rights that come with that ownership are not determined by these centralized powers, and in particular the centralized powers that I'm thinking about are the state and the state institutions, which are increasingly proving to be inappropriate for our digital world and managed by people who don't understand it. So I think we have the ability to build out entirely new structures of institutions, starting with transactional and financial ones, and then also things like governance systems and coordination systems between peoples who don't necessarily have a geographic bond. And so, I think what we're seeing with DAOs, taken to its best conclusion, that is what it represents. DAOs can be a new form of institutional structure for us. I think NFTs can be far more than JPEGs that you put on your Twitter profile. I think they can represent claims of ownership, which may be to physical things or maybe not, but in any event are registered and recorded and transacted not through the auspices of government-sanctioned legal systems, but through the High Court of Bitcoin. And so, I've been extremely vocal about being involved in Sovryn, which is looking to build out on top of Bitcoin, ultimately governed by Bitcoin for its ultimate transaction confirmation, because all of these things are basically boil down to a transaction. The next level of financial and social institutions, because I think we are a generation which has a really huge opportunity in that we can build out a new set of institutions, a new set of global institutions, everything from financial to social to charity institutions, which are based on an entirely different logic. It's a non-border, non-geographic, non-violence logic, which places the individual as the central locus of control and power. And I think that is a world much more free, much more optimistic, and much more innovative. And so I know that that was a very, very high level, but you kind of asked me a broad question, but that's what I'm working on.
Very good. Thank you, Yago. So guys, thanks for waiting. We're going to switch to questions. So if anybody has questions for all of our guests, just request to be a speaker, okay?
Hi, guys. I want to ask how important do you think is the Bitcoin bond in El Salvador, and will the success or not of it will bring more South American countries involved in something similar? I can speak from Colombia. We lost 20% our capital gain against US dollar last year. So I think for us in Central and South America is something quite good.
Well, I think it's extremely important, and I think it's very important that it be successful. And the reason I think it's so important is because one way that I think about Bitcoin is it's effectively providing access, like I was mentioning earlier, to an alternate system, a monetary system, an alternate financial system. And this is going to be the first big test of that on the nation-state level. Now, I'm not particularly enamored with nation-states, but they remain a very important structure in our world today. There's a lot of people who live in countries that are impoverished by a lack of access to strong financial tools. And we see it all the time. So, you know, there are financial organizations which are effectively non-state organizations, but are controlled by, the G9, right? So these are things like the World Bank, the IMF, FATF, and we saw an example just this week of the IMF pressuring Argentina to reduce the ability for Argentinians to participate in the Bitcoin space in order to refinance a loan. Now, so even if we just look at this at the level of providing these countries with an alternate window of finance, there's a huge amount of sovereignty that these countries can gain. There's access that these countries and the people living in these countries can gain to a financial system and to financing without the political strings attached. And there's always political strings attached. So, China will provide funding with Chinese political strings attached. Russia provides funding with Russian strings attached, and the US and the IMF provide their own strings. So having a system which is a free market system without strings attached is extremely important. But I also think that it opens the door and accelerates the process of reducing the actual importance of sovereign funding and of states, even if initially they benefit from this as the state structure by building confidence, liquidity, and sort of a full cycle of economic activity in Bitcoin. Ultimately, we defang a lot of the centralizing power that states have, and that is a net benefit for individuals across the world.
Okay, thank you, Yago. We also had another question from Discord from Ryan H. It was for Troy. He was saying environmental FUD or FUD is the most common tactic used against Bitcoin. What could you tell our listeners to say to people in a nutshell to just shut down doubts about that, or just as a defense?
Yeah, I wish there were some kind of pithy one-liner shutdown of the ESG FUD, energy FUD. But I don't think it's that simple. It really does require you to, first of all, realize how insignificant the energy use of Bitcoin is. It requires you to understand the halving. And the halving means that unless a fee market develops in Bitcoin, we have to double in price every 4 years in order for our incentive to remain the same, because the block reward drops in half. So in a couple of years, we're going to have block reward of 3.125 Bitcoins per block. That's half of the current block reward. And suddenly miner revenue will cut it basically in half because only 1% of miner revenue is from fees. So other things being equal, you would expect mining to have, because mining revenue will have in 2 years. And that will happen again 4 years later, right? So there's like one, it's kind of complicated, but there's one anti-FUD piece. What I said before was that Bitcoin mining is ideally suited to renewables. And my own opinion on this is that in the future, mining will only be profitable with ultra cheap power. Once we see margins shrink, and once we see the grid penetration of renewables reach a very high percentage, so that we have a lot of intermittency problems, we have a lot of problems with matching supply and demand curves and having a functioning grid, there's going to be a lot of super cheap power out there, a lot of negatively priced power. And it just will not make any sense at all for anyone to mine with any machine on anything like retail power or commercial power. So Bitcoin will be completely non-competitive, completely non-rival. And one thing I didn't talk about earlier, and this is my own idea with Andrew Bailey, is that I think right now, if you want to own Bitcoin in a carbon neutral way, it's pretty easy to do it, actually. Here's the formula we have. If you own, let's say, 1 Bitcoin, that's roughly 1/18 millionth of all Bitcoin. It's actually a little bit more than that because a couple million Bitcoin have probably been lost. So maybe 1/16 millionth of all Bitcoin. If you look at the hash rate right now and you start mining yourself with carbon neutral sources of energy at 1/16 millionth of all the current hash rate, then your incentive to other miners will basically be zero. So you own, let's say, 1 Bitcoin, you do a certain amount of mining that's equivalent to 1/16 millionth of all mining, and you do that yourself with carbon neutral sources, and your Bitcoin is actually carbon neutral. And the way that works is that there's a fixed block reward, and that's achieved by a difficulty adjustment. And whenever you add hash rate to the network, you drive up difficulty in principle. And that drives down the profitability of mining for every other miner in the network. Every single miner drives down the profitability of mining for every other miner. That's how mining works. It's a zero-sum game. So when you buy Bitcoin or hold it, you drive up the profitability of mining by making that block reward worth more. But when you mine, you drive down profitability by driving difficulty up. If you can match those two incentives, then your holding of Bitcoin and mining combined makes no difference to the balance sheet of other miners, the profitability of other miners. Because while you'll be pushing the value of their Bitcoin up, you'll also be pushing the difficulty up and making it harder for them to mine Bitcoin. And that perfect ratio is just when you mine the same percentage of Bitcoin as the percentage of Bitcoin you own. So that's a long story. Probably didn't make sense just now. But the long and short of it is you can own carbon neutral Bitcoin very easily just by doing some mining or making an investment in a miner that mines in accordance with the way you think mining should be done. And it's not hard to do because the ratio of all Bitcoin to all mining in a given year is a huge ratio, right? The market cap of Bitcoin is something like $800 billion. The total revenue last year from Bitcoin mining was like $16 billion. So to do your percentage of all mining, it requires a very, very small investment. We calculate it to be about 0.5% of your total investment in Bitcoin over on a quarterly basis, and then you would kind of recalibrate. So long story short, there is no simple answer to the ESG FUD. Bitcoin mining is a very energy-intensive business, but it's often overblown. It's the actual use of power of Bitcoin is misconstrued. It's generally a non-rival consumer. It benefits renewables, but also if you want to, you can hold Bitcoin in a carbon neutral way by using the unique features of this protocol where supply is limited. And when you take Bitcoin off the table through mining yourself, that Bitcoin is not there for anybody else to mine with. And, very counterintuitively, if a government, let's say, wanted to reduce carbon output from Bitcoin, the thing they should do is not to ban Bitcoin. That has the opposite effect. We saw Bitcoin banned in China. What happened? It fled to Kazakhstan. It fled to Europe. It fled to the United States. Hash rate recovered and energy use recovered and then some. And the same thing would happen if they banned in Europe, as they contemplated, if they banned in New York State. Hash rate will just go elsewhere because the supply of Bitcoin issued is not at all changed. That's dictated by the algorithm, right? So it's just impossible to reduce Bitcoin mining by banning it. But if you really wanted to reduce the emissions associated with Bitcoin, you were a government, you should do what El Salvador is doing, which is to mine it yourself and displace the kind of mining that you don't want to see. So, for instance, if the U.S., since the revenue from all Bitcoin mining last year was, let's say, 15 billion, 16 billion, if the U.S. invested $15-20 billion annually in Bitcoin mining, of course, they couldn't get a hold of those machines, and it's kind of not really possible to do this. But if they were to do that, and they were to do it all with green energy themselves, they would basically make it unprofitable for anybody else to mine anywhere in the world. And then all of those coal-driven mines in Kazakhstan would just shut down, not because they're being regulated out of business, but because the government would basically make it unprofitable for anybody else to mine. It's a tiny business compared to major industries in the world, Bitcoin mining. Bitcoin itself is pretty big, 800 billion, but the mining industry is a pittance. And so I don't advocate for governments to do that, but for individuals to do that. Back to Yago's point, if you want to see the Bitcoin mining network be a certain way, and you're troubled by its energy usage, rather than just like avoiding Bitcoin, you should do the opposite. You should actually jump into Bitcoin and make an investment in mining, because every investment you make in mining, the way you want it to be done, drives up the cost of mining for everybody else. All right, that was a long-winded response, but there it is.
So I should hodl, get solar, and start mining then.
Yeah, it's hard to mine with solar, but people are doing it. People are doing it with S9s, and it's actually pretty cool. If you need heat and you have solar, you can kind of benefit both ways. You can use your solar power during the times where you have excess production to run an S9 and offset your heating bill as well. Some people are actually doing that. It's really cool.
I like it, actually. Yeah. Okay, guys. So thanks for that, by the way, Troy. We have one more question. It's from Anurag Saika. You can unmute yourself and go ahead. You have the floor.
Thank you. Thank you for the opportunity. Greetings from India. Okay, so my question is an extension of the point that Troy made. You said that, the Bitcoin mining industry is a very, very small, industry compared to many other industries. So, as you said, US, for example, could, spend a couple of billions and, completely drive out the other miners. So does that, in at least in my mind, I think that presents itself as an attack vector for Bitcoin. What would you say? What's your opinion on that?
Yeah, it's definitely an attack vector. It's one that I worried about, from my earliest days in Bitcoin. It seemed to me obvious that the right way to attack Bitcoin was through gathering a majority of hash rate. But nobody did it. I'm kind of amazed nobody did it. And it gets harder and harder to do. And right now, the problem is not money. It wouldn't take a lot of money to attack Bitcoin in that way by making mining uncompetitive. The problem is this actual availability of machines. You have to get those chips, and they're just not available in enough volume that sort of one buyer could dominate. And I think if one buyer started to dominate, we would know about it, actually, because talk about small businesses. Actually, the manufacture of ASICs is a much smaller business than mining. So, and a lot of the hash rate now is actually done by older machines. So it would just take an incredible effort, one that would be very visible, to manufacture and collect a majority of hash rate, especially now that hash rate has migrated from China. Because my big fear was when it was in China, the government could just knock on the door of various miners and, for that matter, miner manufacturers and just say, okay, you belong to us now, and you'll do what we say. And that's not possible anymore now that we have, I don't know what it is, 30% of the hash rate in the U.S. and more in Canada. And the U.S. is also not as likely to do that because we have 50 states and mining is separated across the states. And so there's layers of government to deal with. So I don't think it's any kind of imminent worry at all. But long term, if I were planning an attack on Bitcoin at a state level, I would actually use ESG as my front. And I would use the plan of we're going to green the Bitcoin network by doing mining ourselves. Don't worry, we're just trying to green the network. And then I would wrap it in with the Green New Deal so that, we build out infrastructure for power and we use Bitcoin to make it more affordable. And we at the same time drive out coal mine powered Bitcoin, gas powered Bitcoin, simply through competition with the difficulty adjustment. And then once I had done that and highly regulated it, then I would try to seize 51% from there, right? So I would use ESG as my Trojan horse for a 51% attack if I were going to engineer one as a state. And no, I'm not recommending that. I'm just saying that's how I would go about it.
Yeah, I think that sort of clears it. Yeah, thanks for the explanation.
Cool, guys. Thank you so much. So we're going to wrap up now, and I just want to say a huge thank you to Troy Cross and Matthew Pines for both taking part, guys from the Bitcoin Policy Institute. You can actually follow them everyone, at so Troy Cross is at the TROCRO, so the Trocro. Matthew Pines is at Matthew_Pines, nice and easy. Be sure to follow them for all of the great analysis on the environmental aspect of Bitcoin, the policy aspect, the macroeconomics. Really interesting stuff. So we really appreciate you coming on, guys. And of course, don't forget to follow us at Sovryn BTC. And you can keep up with us and all the stuff we're doing to revamp personal finance and sovereignty for individuals. So thanks again, guys. Thanks for joining us. And have a great rest of your day, wherever you might be, everyone in the world. And remember, stay sovereign. Thank you, Troy and Matthew.
Thanks for having me. Thanks for joining.
Thanks for having me on.
Thanks, guys. Be sure to follow them, everyone. Have a great one. Bye.